Rates Live with the Mortgage Calculator. Thank you for joining us this morning. We will wait just a few minutes here to get started. Let us go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us just a minute to go live on all the different platforms. In the meantime, we did just put the chat up, so feel free to drop a comment there in the chat as you tune in. Got a great topic here today, something that a lot of people have questions about. So we will go through that. If you do have questions as we go through our deep dive presentation later, feel free to drop questions in the chat. We'll get to them after we go through our deep dive. Well, good morning, everybody tuning in. Thank you for the comments. We appreciate it. We'll get started momentarily. All right. Just one moment while we go live on all the different platforms here. But good morning to everybody tuning in and dropping comments. All right, looks like we are live on all the different platforms, so we can go ahead and get started. We'll take the chat down so we can get into it. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on this show every morning, every weekday, is go through the actual live rates of different mortgage programs. So we're going to pull up the live pricing of different programs, and then we're going to do a deep dive into a topic like we do every day. Now, today's deep dive is going to be SBA mortgage loans. So here at the Mortgage Calculator, dealing with a lot of non-QM loans, investor loans, and a lot of investor clients, we do deal with SBA loans. And so our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and realtor, is going to go into a deep dive here shortly into SBA mortgage loans. But before we do that, let's do what we do every morning, which is pull up our pricing tool and see what the actual live mortgage rates are looking like today. So Nick, are you ready to pull up the pricing tool there and we can see what the market is looking like this morning?
All right, let me switch my screen and we'll get started. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. This will show us the general rates and the APR with all of the fees. For today, it is July 11th, just after 11 a.m. So all of our standard programs are live. If you would like a full loan estimate with a breakdown of all the fees that go into the APR, please get with one of our team members. We have over 300 licensed loan officers, and we can do primary and second homes in 24 states. And we can offer our DSCR business purpose loans, which we love, in 44 states total. Now for our demos today, we'll set up a basic scenario so we can compare across the programs. So we'll start with a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We'll set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point in cost. It's our most common request these days. And we're going to compare our conforming conventional rates to our FHA rates. And then we will check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. We also offer VA and USDA. VA is only for our eligible veterans and active service members. If you do happen to be eligible, let us know. We'd be happy to quote it, no problem. And same with USDA. That's only for properties that are eligible in a USDA eligible area. If you do happen to be shopping there, just let us know and we'll quote it right up for you. So we'll start today with our conforming conventional. We will do a purchase, 30-year fixed loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all our demos today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with these basic settings, let's check out the conventional rates this morning. Right about where they've been the last few days. 7.25 rate, 0.875 discount points at cost, final APR of 7.413 here. So a little bit lower than it was when things started heating up there, but some great options for our customers that qualify for conventional. Remember, we're going to use the APR value here to compare apples to apples across the programs. So the final cost here of our conventional program this morning, 7.413, is the number we're going to compare. So if our customer, for any reason, doesn't qualify for conventional, we'll set up the same exact scenario and simply change it to FHA. FHA does allow a little more leniency on credit items, as well as a much higher debt to income ratio we can go to. So FHA has a little bit more leniency overall. So most borrowers have a easier time qualifying. Everything else will stay exactly the same on our demo. All we've changed is FHA. So let's compare the FHA to the conventional. So the best option the computer found here, 6.5% rate, 1 discount point in cost, and that puts the final APR, even with the mortgage insurance, at 7.092. So just as almost every morning, when we open up the FHA on this comparable deal, it's actually a little bit cheaper for FHA. So our customers that qualify for both FHA and conventional definitely still consider FHA. Even with the mortgage insurance, it could be a little bit cheaper like it is in this scenario. Now, if our customer has any trouble qualifying for either conventional or FHA, that's where many other lenders or banks don't have other options, but that's where we love to help our customers out. And we'll set up the same exact scenario, but this time we'll go to expanded guidelines, also known as non-QM loans, where we have over 5,000 additional options that most banks and lenders do not have to solve our problem for our borrowers. So we have a new option that pops up for non-QM, which is our income option. Full doc is 2 years of tax return. That's typically what we have to use for conventional and FHA. So we will usually choose a non-QM program in order to take advantage of one of these other options. We have asset-related programs, business bank statement programs. We have our investor DSCR programs we'll talk about for investment properties. Our most popular program by far for our primary home is going to be our 12-month bank statement program. We also have RSU, stated, VOE, 1099, P&L, and no income at all options. So tons of different options here. For our demo, we always choose the most popular, which is the 12-month bank statement option. And that's for our self-employed borrowers. Many times our self-employed borrowers will have various write-offs on their tax returns and either don't qualify at all or don't quite qualify for as much income as they need. And therefore, these non-QM programs allow us to solve that problem. Instead of using 2 years of tax returns, we're simply going to use their last 12 bank statements, no tax returns involved at all, to determine a debt to income ratio of 40% in this case, using their cash in the bank rather than their tax returns. Most self-employed borrowers will qualify for double, triple, or even more income, and therefore can get the home that they want or qualify where they would not qualify. So these non-QM programs will always have a little bit higher rates, but amazing options to solve problems for our borrowers. And we do get excited here when the rates are almost identical to conventional here. So option here for bank statements, 7.375 rate, 2.375 discount points, a little more spendy, but the final APR, 7.487. Remember, that's almost identical to a conventional loan, but using alternative income. And you see some of these other options are a little bit higher on the APR, up in the eights. But remember, these solve problems and may allow other things such as credit events like foreclosures and bankruptcies and other things. So not only can we use alternative income with all of these different programs, we have dozens of them, but some of these at a little bit higher rates may allow some other ways around the different guidelines that would otherwise make us not qualify for FHA or conventional. So tons of different options. Please get with our team so they can find the best one for you. Now, before we pass it over to Jose to talk about SBA loans, we always want to do some live pricing for investment properties. So we love to work with investors, whether you're a first-time investor or seasoned investor with many properties, we have some great options. So we'll set up the same scenario here, 80% loan to value, 20% down payment. And we'll compare our two investment property options. We'll have our conventional options, and then we'll check out our non-QM expanded guidelines options. Remember, all the government programs are not eligible for investments. So FHA, VA, and USDA are not eligible for this scenario. We'll simply compare these two options. So first up, conforming conventional. Everything else is exactly the same as all our other demos. All we've edited here is the occupancy to investment. So let's see what the investment property rates are this morning. So the agency loans here for conventional have added pretty hefty loan level price adjustments, aka penalties for investment properties. So the best option we have here is 7.375 rate for 4.25 discount points in cost and a final APR of 7.65. So a great option for our customers that qualify conventional, but most investors would like a lower discount point option here. 4.25 discount points is actually probably not even legal to do for you guys here. It's just for example purposes. And in this case, $17,000 is a lot of funds that an investor would typically rather deploy elsewhere into another investment. So most investors would ask to go up in rate a little bit in order to reduce the cost. Fortunately, there's not that many options here on our list. So we can solve that problem with our non-QM options. So for the final demo, we'll set it to investment property, set it to 80 LTV again, and this time we'll choose expanded guidelines, aka non-QM. And we have some new options that pop up here. So first thing we have to select is our income. For investment properties, our most popular option is DSCR, and that's our most popular loan here at the company by far. That's because it doesn't require any income or employment. We simply use the estimated rental income from the property we're purchasing to determine a debt service coverage ratio, also known as DSCR. So if the estimated rental income from the property, the gross rental income, can cover the PITIA of the mortgage expenses, that's a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. We even have options for properties that don't cash flow on a monthly basis. That would be a ratio under 1.00. So tons of different options that we can show. For the demo, we always put in 1.5. That's the highest option, just so all the different programs pop up. And the final thing we need to select here for any DSCR or non-QM investment property is a prepayment penalty. It is standard to do 3 years. That's what we always do for the demo. There are options for no prepayment, but not all loan programs allow it, and it will cost more money. And say with 5 years, not all programs allow 5 years. It does save us a little money when those programs do exist. But for our demo, we always choose 3 years because that is the most common. So with these settings, let's check the DSCR options this morning. So, hope this is a DSCR option. A little confusing there on the naming there, but 8.125 rate for 0.975 discount points and costs. Solved our problem there for our investor. And a final APR of 8.191. So obviously the DSCR programs are a little bit higher APR, but just a touch there. So just about 0.5 higher on the APR in cost overall. And our customers take advantage of no income, no employment. Investors that have multiple properties can refinance multiple properties and purchase multiple properties. And just as with the other non-QM programs, if we cruise down here to some of these options with different prepayments, some of these other options at higher rates may allow things like short-term rental income, may allow things like foreclosures and bankruptcies. Tons of different options that we have here under our non-QM. So please get with our team and find the one that fits best for you. And let me go ahead and switch my screen and we'll get into Jose's deep dive today, now that we've done all the live rates. So for today's topic, we're going to be talking about SBA mortgage loans. So yesterday we didn't get a chance to do the regular commercial properties, but we'll go ahead and pick that up here shortly, probably tomorrow. But today I'm going to have Jose talk about our SBA mortgage program. So SBA does offer financing that's not related to mortgages, but what we're going to be talking about is SBA as it does relate to mortgages, which is the more common option for us here. So I'll let you go ahead and define what you put in the samples here, Jose, but that's kind of the basic parameter here is we want to make sure we're focusing on an SBA loan that does include some sort of mortgage component.
Awesome. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. SBA loans are pretty amazing when you consider what they're allowing you to accomplish. Mainly, it's a primarily owner-occupied property. For any SBA loan, the the space of the property, the usable area for the business, has to be at least 50.01% occupied by the owner. As you all know, in the commercial world, that is actually seen as a weakness when you have an owner that is occupying the majority of the space, because underwriters prefer it to be investment. They prefer to spread the risk and not concentrate the risk in one person, or mainly in one person, namely the owner. Because if the owner's business goes down the drain, so usually will the mortgage. Well, that is where SBA comes in to save the day and offer some amazing options for purchases, as well as some refinance type transactions that you normally may not consider. So, um, so for our first option here, it is for, I'm just going to go right to the meat and potatoes here, 100% LTV SBA purchase. Yes, it's not a typo. It is 100% financing for a commercial loan purchase of an owner occupied property. Now there is, certain conditions that would need to be met, because normally SBA financing is up to 90%. In order to make it to the 100% plateau, it has to be an existing business where the borrower has been already making payments for a similar space for at least the last 2 years. It could be the space that they've been leasing that they're now.
Can you zoom in a touch there, Jose? We can't.
Sure.
I'm sure most people can't read it, but there's no chance right now.
Yeah. Okay.
Look, that's too much, maybe. Well,
all right.
Actually, that works.
That's good. Okay,
cool. Thank you.
So, in order, so like I was saying, it doesn't necessarily have to be the space that they're currently occupying. That does happen. I'm actually doing one today where the borrower is going to buy the space from the owner of the property. So it's going to be a great deal. Maybe he'll get that 100% LTV financing. But that is the only catch there, is that is it. You have to have already have established a payment history for your business in a similar type space for the last 2 years. So you're running your business out of a warehouse, and now rather than keep renting, now you want to be the owner of the business. So maybe you'll get to buy the warehouse you're renting, or maybe you'll buy another warehouse, similar for your business plan. If everything lines up as far as your income and your credit and all those other factors that they're going to review, and your business plan as well, very important to have a nice detailed business plan for SBA, then you should be able to obtain 100% financing, 100% LTV for your SBA purchase. So again, SBA at least 50.01% owner occupied. So now the more traditional deal would be the 90%. Actually, hold on. I was so excited about the 100%, didn't get to the rate. So you're looking, in our example here, we're looking at $1 million purchase, $1 million loan amount. So the rate, you're looking at around 10.75%, right? And there is a charge here on this product of 2%. That's not a buy down, that's just what they charge to do the loan. Now, a 90% purchase, same, this is the more traditional SBA option. Typically, this is the option that the new business owner receives. Now, this is the best case scenario, right? It's not a guarantee that you're going to receive 90% LTV. Again, it depends on your business plan. Depends on the pro forma profit projections, your credit, your current income. All of these factors come into play when they underwrite the risk to see if they'll let you max it out to 90%. Same with the 100% option. 100% is the max, but again, all the other factors have to be reviewed. And if they may want to hedge the risk a little bit, you may not get that full LTV. So again, SBA for when you are at least 50.01% occupying the space as an owner occupant. You are able to rent out the other spaces, by the way. So now this is a little bit different here. Now, I keep not showing you guys the rate. I get so excited. Again, 10.75 the rate, a little bit less in the fee because the loan amount is 900 instead of $1 million.
Can you explain a little bit about the rate here, Jose? Because SBA does use a different method to get to the rate. It's a variable rate, essentially, for almost pretty much all these SBA products, correct?
Yeah. Yes, correct. I mean, there's going to be an index. There's going to be a margin. That's where the analysis of the credit and the income comes in, depending on the risk, right? So again, this is a hypothetical situation here. So I discussed it with the SBA underwriter, and I put a more or less average rate that's being offered, but it really is going to be risk related. And risk, as you know, is going to be determined by analyzing a number of factors like credit, income, business experience, type of business, all location, all of those things are going to come into play. And it is a variable rate with a margin. So the margin is what's going to be adjusted to, reach your final rate depending on the risk assessment. So yeah, it's not a 30-year fixed rate by any means. Now, SBA does allow the refinancing of the existing debt, right? So it can be a short term, as low as short as 10 years if no real estate is involved. So if it's a business debt that is in good standing, it can be refinanced, but the business's cash flow has to be improved. So maybe you're refinancing some higher interest rate, not just the SBA debt, but maybe some additional debt that the business has incurred. So it's all about improving the cash flow. If there is no betterment of the cash flow of the business, it's just not going to happen. And talking about the rates, you're looking at prime, same as the one we're looking at, prime plus anywhere from 1.5% to 3% margin, which is what we were mentioning a second ago regarding what your final rate could be. So it could be as low as prime plus 1.5, prime, to prime plus 3. I can't recall what prime is today right now. I don't know if it's 8.25, 8.5, somewhere in that range. And again, like mentioning there in the notes, a solid business plan is essential. If real estate is involved, you're looking at a term up to 25 years, and there is no minimum credit score. So it's just, underwriter's going to review it. There's no DU or LP on here. This is a fully manually underwritten process. So that's where all your letters of explanation and everything else becomes very important to tie in all the loose ends. Now, here's another really cool option, the SBA business expansion, right? Growing the restaurant from 12 seats to 50 seats, adding another bay to the warehouse or to the mechanic shop, whatever it may be. It could be that you're buying a new business and you have your business plan to expand that business at the same time. So, that is possible. So this is a full doc program for owner-occupied businesses, like I mentioned, where the owner occupies at least 50.01. And again, we're looking at the same rate range, because unless we really had a specific loan that we're analyzing, then we would end up with a possibly a different rate. Here I'm looking at worst case scenario, highest margin, but your rate could easily be 9.25 or not, or not 9.25. Yeah, 1.5 plus prime. So your rate could be 9.75 easily as well if you're in a lower risk scenario for the underwriter. So this is a more, and I wouldn't say this is the worst case scenario rate, but it's getting up there to what the max could be. And last but not least, this is the one that's a little bit of a mind blower. This is where you have a leasehold. So this is the business expansion that can be for either owner occupied locations or leasehold. Again, we're talking about the restaurant operator that may need to expand a current location or move into a bigger location and build it out, right? So SBA will lend on this type of a situation. But again, keep in mind that if there's no real estate involved with you as the owner of the real estate, it's going to be a shorter term than if you're looking at also owning the real estate as well as the business.
All right.
And we're looking at the same rate there again across.
Yeah, you forgot the rate. I was gonna say.
Yeah, yeah. Sorry, I get so excited talking about all these cool opportunities. That most of the time when we're talking to the people, they're reacting the same way.
All right. Looks like we got a couple questions here. You want to pull up the questions, Nick?
Yeah, can a nonprofit qualify for a cash out refinance using SFR as a rental? I have no idea what that means exactly. Why would a nonprofit have a SFR as a rental, and what does that have to do with their primary business purpose? That's a confusing one there. Jose, do you understand what he's trying to ask?
I mean, the first part of the question, I guess I could try to answer that, but the part where we're using a single family residence, I'm assuming that's what SFR stands for, as a rental. I'm not really sure. Now, can a nonprofit qualify for an SBA loan? Well, you got to have profit in order to qualify for the loan. So I'm not.
Well, if they have a rental space, yes, they could. Yeah. But yeah, they have to already be paying a rental space in order to have the room in their budget. In order to qualify for the SBA loan, they have to have a budget for the rental.
Yeah. So as long as as the business plan has budgeted to cover the payment, I would imagine there's no need for the business to, if that's their business plan, to make a profit, but they do have to cover the expenses is essential.
Yeah. So I don't know what this SFR thing is, but say it's a nonprofit community center, right? Where they maybe teach kids music, right? I do work with a nonprofit here for that. We could finance the space where they teach kids music for the nonprofit because that's their goal, right? So I think a little bit of confusing there of what the purpose of the space is, right? So SBA is only going to finance a space if it's used for the purpose of the business, not for investment purposes, right? SBA
and not
is only
for real estate, right? That's the
yes.
They're not a real estate investing. Your business isn't going to be investing in real estate, right?
Yeah, you can't use SBA to speculate on real estate. It's only for primary occupancy of a business, which is different than primary occupancy of a homeowner's primary home. Okay, next question here from Joe. SBA only done for business entities, no personal. Exactly, right? There is no such thing as a person applying for an SBA loan. The owners of the company must qualify for an SBA loan as far as they can't be criminals, no federal crimes. They have to do, background checks and stuff like that. They have to have credit. But once you qualify as a person for SBA, every United States citizen qualifies for up to $5 million of SBA funds. So once you qualify as a person, you're not a criminal, and you have a valid social security number, and you have a clean background check, you as a person, as a business owner, qualify for SBA. That's the easy part. After that, once you as the business owner qualify, then everything Jose explained comes into play, right? The business has to qualify. The rents, if you're changing from rent to own, the rents that you're currently paying must, essentially cover the cost of ownership as well within your budget and all those kinds of things. So the person has to qualify, and every U.S. citizen is qualified for up to 5 million maximum. And remember, for example, me and Kyle have an SBA loan, and we're 50-50 owners. So we qualify for 5 million each. So even though we've only spent a couple million of our SBA funds, since we have 10 million between us, our company and ourselves that qualify can spend more, right, with that initial qualification. So the people qualify for 5 years, you get up to 5 million, and then you can requalify again, check your background again. Then the business has to qualify. So there is 2 levels there, Joe. Great question.
And one thing I also wanted to add, the owner is a personal guarantor on the loan.
Mm-hmm.
And a lot of times what you're going to see with some of these SBA loans is that they'll be looking for assets of the owner to collateralize if there's not enough equity or whatever they're doing. I've seen it where they'll put a lien on their primary residence if there's equity there as part of the deal.
And same thing, if you default on an SBA loan, there is no protection of your personal assets. Your personal assets will be liened on. I had a borrower that had 14 townhomes, investment properties he owned, that were liened because an SBA loan defaulted, right? So they are very strict, right? You can't, not like a normal, SBA is not a normal lender, right? They're the government. They can lien on anything at any time, right? It's almost like a tax lien. So they supersede a lot of the stuff that a normal lender would not be able to do. So definitely be careful there. Let your customers know what they're getting into. Great deal. But with the great deal comes a little bit more layers of bureaucracy and risk and all that kind of stuff.
It's very cool, though. I mean, our SBA loan was amazing.
Yes, and the rates were much lower when the margin was 2% and the rates were 0. We were paying 2% on our SBA loan, right? So now because the it's basically the prime rate plus a margin is going to just put you way up there. So Nicole's question here, Jose, what's the FICO minimum for purchase?
Well, there is no minimum FICO. The underwriter is going to analyze the credit and see how it's being handled and see what business plan is put forth and see the cash flow of the business and see if it makes sense. And then that's where the margin comes into play that they add to the prime rate. If they sense there's a little bit higher risk because of the credit history and if they decide to approve the loan, it's going to have a higher margin than the better qualified borrower.
And remember, guys, this is a government program, so the SBA qualifies the person not based on FICO, based on if they have federal crimes and if they have a clean background check and if they have a valid Social Security number with no other tax liens or anything like that, right? It's a government background check. It says you are a citizen, you're entitled to 5 million, you have credit, doesn't have to be a certain score, and they basically do the general background check. So as a person, it's very easy to get through that step. But as Jose explained, you still got to work with a bank, right? SBA doesn't underwrite loans, banks do, right? So you're going to deal with a typical underwriter. It's going to look at all your typical stuff like FICO and stuff like that. But the SBA technically doesn't, right? Great questions here. Most questions we've ever had, I think, here on this show today, guys. This is good. Benedict asking, does SBA program cover startup business looking to buy property for a lounge bar? Great question.
Yes. Again, it comes down to the business plan. Now, I'm not sure if I think what you're meaning by to buy property is to buy a location, not to buy land to build the lounge or bar. But if you're going to buy a location and then you have to build it out as well, and get some capital for the business as well, those are all different components of the SBA loan that could be worked into the loan. They will definitely lend the money for the location, lend the money for the build out as well, and even lend you some capital to get yourself going. But that's why you have to have a very precise and detailed business plan to let them know step by step how it's going to go, because obviously they know that in the beginning you got to build some momentum before the business starts generating a profit. During that time, you may need some money. So some of that's going to have to come from your savings, and some of that could come from the SBA loan.
Very difficult. It's a
more
difficult
questions.
loan to do, right? So it's not easy. It's difficult. It was difficult for
Yes.
me and Nick to do it, and it would be even more difficult on a nightclub. I can't imagine buying our nightclub with an SBA loan, right, Nick? Our nightclub was hard enough to buy with seller financing, let alone an SBA loan.
Yeah, so keep that into consideration. You're going to need at least 90 days on the contract, more likely 120 days on a contract for an SBA loan. So those are common for commercial, though. Remember, we're buying a commercial property, so those are common terms for a commercial contract in general. But make sure you let your borrower know that they need to get extra time, because it's going to take 30 days just to get approved from the SBA before you can even apply to a bank and say, "Hey, SBA approved me. I'm a citizen. I can get up to $5 million." Now the bank application starts, right? Two different processes there. But Joe had a question here. Jose, minimum seasoning of the business for SBA.
Well, there's not really a seasoning requirement now. If you want to get the 100% option, then we were mentioning there that that's at least 2 years seasoning, because you have to show 2-year payment history on the space, not necessarily the space you're buying, but on the type of space that you're buying, right? So to try to get the maximum LTV option, it can't be a newly established business. But other than that, for the 90% max option, there is not a seasoning requirement necessarily. But just keep in mind that that increases the risk of the loan, and that's where your business plan, your pro forma of income and expenses is going to be so important, to really be precise, detailed, documented as much as possible. All the forecasting that is going to be involved, because you're having to convince an underwriter that you're good for it, and they're going to have some information to be able to chew on and provide a decision. And if you don't convince them that it's going to happen and that your business is going to exist, then they're going to deny the loan.
So this is a great question here. The answer is 0, though, as Jose said, right? You can do a brand new business that doesn't exist yet. So the best option for this, as Jose said, is going to be nearly impossible if you didn't own a prior business that does exactly what you're saying you're going to do, right? So the restaurant, right? You can't just come out of the blue and say, "I used to work in tech, now I'm going to own a restaurant. Approve me for a brand new restaurant with no track record," right? You can apply for it. It technically fits the guidelines, but you're not going to get approved for it. But if you're a restaurateur who's successfully exited multiple restaurants and bars, and now you're looking for SBA to help you on your next venture, and you have a proven track record, then that's going to be a slam dunk deal for any underwriter and the SBA portion to approve. The other thing I would recommend here is, the only other thing that really works for this is, one, a proven track record of multiple years and multiple exits for your borrower. I worked on one that was like a urgent care doctor, right? He already had a practice. He just didn't have one in this state, right, that he was applying for. But same thing, too, with an urgent care type of situation, or a restaurant, or any of these other types of things. A franchise would be your only other option, where there's a business plan already created. It's a successful business plan is proven. The underwriter can see success stories, can see proven budgets, and can see basically a proven setup that's a business model that they can then approve as a new company. Very difficult to get a brand new company. If you're just coming up with an idea, I would definitely recommend to go, as Jose said, 2 years on your own if possible. Then you'll get the best rates and terms and everything. If you're coming in with a fresh business, you're going to need to be very experienced, or use a franchise type model to get all the paperwork that you need, and all the stuff that Jose said to chew on for the underwriter will be a nice, pretty package already ready for you to go. So those would be the two best options for that.
All right. I think that's the end of the questions, but definitely some great questions there, and definitely great programs. It's going to take some work. It's going to take some time. As Nick said, make sure you got a lot of time on that purchase contract. If you're doing a purchase, it's not a regular transaction, but it is an amazing thing to take advantage of. We've had clients take advantage of it. Nick and I have personally taken advantage of it, and it's an amazing program. Lots of amazing different programs that they have there at the SBA. So if you want more info on that, you can visit us at themortgagecalculator.com. We can pair you up with one of our loan officer consultants to walk you through the process. Remember, we do this show every single weekday at 11 a.m. Eastern, where we go through the different live rates for the different mortgage programs, and then we do a deep dive into a different topic like we did today here with the SBA loans. So thank you everyone for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.